What if I told you that a company could bleed nearly $200 million in a single quarter, miss Wall Street's revenue expectations by 60%, watch an early backer dump 4.5 million shares, and lose a satellite to a rocket failure, and then somehow have its stock hold up like it barely flinched? That isn't a hypothetical. That is AST SpaceMobile, ticker ASTS, right now, sitting at $74.81. Welcome back to Smart Stock Sam, where we cut through the noise and give you the tools to think like a professional investor. I'm Sam, and today we are going deep on one of the most volatile, most divisive names in the entire market. Should you buy the dip right here, or wait for a potential flush to $66 before pulling the trigger? Stick with me, because by the end of this video, you will have a clear, data-backed answer. We are covering the ugly Q1 financials, the $3.5 billion fortress balance sheet, the satellite drama, who is buying, who is selling, and exactly how to position yourself. Let's get into it. To understand where we are right now, you need to understand the crossroads this company is standing at. After a legendary run in 2024 that turned ASTS into one of the most talked-about growth stocks on the planet, the stock has pulled back hard, down roughly 30% from its January highs. On the surface, that sounds terrible. But here is the question you need to ask. Is this a business breaking down or a stock that got ahead of itself and is now resetting? Because those two things are very different. The reaffirmation of full-year 2026 guidance tells us management believes the business is not breaking down. And the clearing of a massive institutional selling overhang, which we will get to shortly, tells us some of the artificial pressure is finally lifting. The investment thesis is not just intact, it is being stress-tested in real time, and so far, it is holding. Now let's talk about the actual Q1 2026 financial results, because you deserve the unfiltered truth. Revenue came in at $14,740,000. That sounds respectable until you realize Wall Street was expecting somewhere between $38 and $39 million. That is not a small miss. That is a 60% miss. A miss of that magnitude would crater most stocks by 20 or 30% in a single session. And the bottom line, even rougher. The diluted loss per share landed at 66 cents, more than double the anticipated loss of 24 cents. The net loss for the quarter widened all the way to $191 million. And operating expenses? They surged 158% year over year. 158%. To be clear, that is not a typo. Now ask yourself, why would a company with a credible long-term vision spend money that aggressively? Because they are racing to build the world's first space-based cellular network, and standing still means falling behind. They are aggressively expanding their manufacturing footprint and workforce out of Texas, preparing to produce satellites at a pace the industry has never seen. For most companies, numbers like these would signal the beginning of the end. But ASTS is not most companies, and here is why. While the income statement looks painful, the balance sheet is a completely different story, and this is where the narrative changes completely. Despite those losses, ASTS is sitting on $3.5 billion in cash. Let that number sink in. $3.5 billion. Management has been unambiguous. They have a fully funded runway to deploy the next 45-plus satellites without needing to come back to the market for dilutive financing anytime soon. No desperate secondary offerings. No convertible notes that punish existing shareholders. That cash cushion is extraordinary for a pre-profitable growth company in this environment, and it fundamentally changes your risk calculus as an investor. And then there is this. Despite the Q1 miss, management reaffirmed their 2026 revenue target of $150 million to $200 million, and half of that target is already locked in through a contracted backlog. This isn't wishful thinking on a whiteboard. Half the revenue is already spoken for. On the technology side, they just demonstrated peak download speeds of 98.9 megabits per second, directly to unmodified smartphones, not specialized devices, not custom hardware. Regular smartphones that you and I carry in our pockets. When your partners are AT&T and Verizon, proving the technology works at scale like that is the ultimate de-risking event. Could this be the moment that separates the believers from the skeptics for the next several years? The data is starting to suggest yes. Now, none of this means anything if the satellites don't actually get into orbit, and that is where the story gets both exciting and heartbreaking. First, the massive win. The FCC granted authority to operate up to 248 satellites within the United States. That is a regulatory green light for commercial scale that had been a major question mark for the bears for years. Bears love to argue about regulatory risk. Well, that argument just got a lot harder to make. But then came the setback. In late April, the Bluebird 7 satellite was lost due to a launch vehicle anomaly. The hardware was fully insured, so the direct financial impact is limited. But the real cost is time. In this business, time is everything. Schedule slippage means delayed revenue, delayed coverage, and delayed proof to carriers and investors that the deployment cadence is real. This is the risk that keeps institutional portfolio managers awake at night, and it is absolutely legitimate. Here is the uncomfortable question, though. What if the next launch fails too? Could a second consecutive launch failure push this stock to a place where even the long-term believers hit their breaking point? That scenario is unlikely, but it is not impossible, and you need to have a plan for it. For weeks, this stock had a dark cloud hanging over it in the form of a supply overhang, and until you understand what that is and why it matters, you cannot fully understand the price action. Rakuten Mobile, one of the early strategic backers of ASTS, completed a pre-planned sale of 4.5 million shares. Major shareholder Hiroshi Mikitani also sold approximately 3 million shares. Even the CFO, Andrew Johnson, had an administrative disposition of 30,000 shares for tax purposes. When you have millions of shares hitting the bid every single day, the price simply cannot move higher. It doesn't matter how good the news is, the supply overwhelms the demand and the stock bleeds. This is normal behavior for early-stage company insiders and strategic backers who are monetizing positions they've held for years. It is not necessarily a bearish signal about the company's future, and here is the most important part for you right now, that selling pressure is largely over. The exit of these large blocks clears the way for a fundamentally different supply and demand dynamic going forward. The headwind just turned into a tailwind. So if the insiders and early backers are trimming, who is actually stepping in to buy? Institutional ownership is holding strong at 60.9%, and the behavior among major funds is absolutely fascinating to watch. On one side, you have the Norges Bank, the world's largest sovereign wealth fund, which added a massive 2.7 million shares in late 2025. When the single largest pool of institutional capital on Earth is adding to a position, that is not a casual move. That is a conviction call backed by years of research and billions of dollars of risk management. On the other side, Susquehanna trimmed nearly 80% of their position. The divergence between these two camps tells you exactly what kind of stock ASTS has become. It has moved from being a speculative play for everyone to a high-conviction play for a select few. The volatility we are watching unfold is essentially the market's way of deciding which camp is right. And over the next 12 to 24 months, one of these camps is going to look like a genius. What is a company actually worth that is building a cell tower in the sky? Wall Street's answer is cautiously bullish. The average price target from analysts currently sits between $82 and $84, which represents roughly 12% upside from current levels. But look at the spread of those targets, because it tells you everything about the uncertainty here. Deutsche Bank and a handful of other firms have targets stretching all the way to $117 to $122. At the other extreme, the bears at Scotiabank are sitting at a $41 target. That is not a small difference of opinion. That is two entirely different versions of reality. The critical date to put on your calendar is 2028. That is the profitability horizon. Analysts don't project net income until then, but when it arrives, they expect annual revenues to explode to $1.6 billion. Here is the mindset shift you need to make. If you are considering owning this stock, you are not buying Q1 2026 earnings. You are buying the 2028 cash flow machine. The price you pay today is a bet on whether this company can execute over the next 2 years. Everything else is noise. Let's look at what the charts are telling us, because for short to medium-term traders, the technical setup right now is actually very specific. The stock is in what I call repair mode. We have a clear ceiling of overhead resistance from the 20-day and 50-day moving averages, which are clustering around $84, but the floor is equally well-defined. We are resting just above the 200-day moving average, sitting at $74.28. This is the line in the sand. As long as ASTS holds above this level, the long-term trend structure remains intact and bullish. If we break below it with conviction and close below it on volume, the repair phase fails, and we likely see a deeper flush toward the mid to upper 60s. Right now, the stock is coiled like a spring between these two levels, and a resolution is coming. The only question is which direction it breaks. The momentum indicators are painting a picture of extreme neutrality, and that actually means something. The RSI is at 46.28, sitting in no man's land. Nobody is panicking, and nobody is euphoric. The MACD is showing early signs of bottoming, but it has not yet crossed above the signal line, which means we do not have a confirmed buy signal from a momentum standpoint. We are close, but we are not there. And the average true range, the ATR, is sitting at 6.2, $6 of average daily movement. Think about what that means for your position sizing. If you are trading this with tight stops or excessive leverage, the market will eat you alive before you even have a chance to be right. This stock demands strict, disciplined risk management, smaller position sizes than your average blue chip. Defined risk, no exceptions. Here is where it gets really interesting for the contrarians and the short squeeze hunters in the audience. Short interest sits at 20.31% of the float, nearly 54 million shares sold short that will eventually need to be bought back. The days to cover ratio is 2.5, which means it would take shorts approximately 2.5 days of average volume just to close their positions. One single piece of good news. One successful launch, one major carrier announcement, one guidance raise could trigger a squeeze that sends shorts scrambling for the exits simultaneously, and the options market is already voting on the direction. Call volume is outnumbering puts by 3 to 1, with massive open interest clustered at the $75 and $80 strike prices. Traders are not just hoping for upside. They are paying real money to bet on a 15% move in the near future. Could this be the short squeeze setup of the year in the space sector? The mechanics are absolutely in place. Your strategy depends entirely on your time frame. For short-term traders, the critical metric to watch is dark pool activity. Off-exchange short volume recently peaked above 50%. Which represents heavy bearish institutional pressure that isn't visible on the main exchange tape. When that dark pool activity begins to flip, when the off-exchange buyers start outnumbering the sellers, it typically precedes violent upside reversals. Watch it daily. For long-term investors, your North Star is asset productivity. Ignore the quarterly noise. What you need to watch is the conversion of that $1.2 billion in contracted commitments into actual, recognized revenue. The magic threshold is 45 satellites in orbit. Once that number is hit, ASTS achieves the coverage density required for continuous global service. That is when the revenue floodgates open and the financial model starts to look very different from what we see today. Here is the trade setup with clear levels. My overall bias is cautiously bullish, but price matters. The entry zone I am watching is $70 to $73.50. This zone aligns with the 200-day moving average, and represents the range where institutional buyers have historically stepped in to support the stock. If you are building a position, this is the area to do it, in stages, not all at once. The hard stop loss is $66. A decisive break below that level means the technical structure has failed, the thesis is on shaky ground near term, and a move into the mid-50s becomes the more likely scenario. Do not ignore that stop. If the trade works from the entry zone, the first target is $84 to $86 to test that 50-day moving average resistance. Clear that level on volume, and the next destination is the $100 psychological breakout level. High reward, clearly defined risk. That is the setup. Everything we have covered today leads to one single event that will define the next chapter of this story. The upcoming SpaceX launch of Bluebird satellites 8, 9, and 10, expected in mid-June, is the ultimate validation moment. This is where theory meets reality. The Q1 miss and subsequent recovery proved one thing beyond any doubt. The market is willing to forgive bad earnings as long as the long-term vision remains believable. ASTS has a $3.5 billion commercial safety net that most growth companies would dream of having. But the grace period ends in June. If those 3 satellites reach orbit successfully, the $100 price target moves from a stretch goal to a realistic near-term possibility. If they don't, we're back at the drawing board. The bears take control, and $66 becomes the next stop on the downside. Expect extreme volatility as that launch window approaches. Plan your position around it, not despite it. Before we close, I want to be very clear about something important. Nothing in this video is financial advice. I am not your financial advisor. I am not your broker. Everything I have shared today is purely for educational and informational purposes. Always do your own research, understand your own risk tolerance, and consult with a licensed financial professional before making any investment decisions. The stock market carries real risk, and you can lose money, including your principal. So here is your final takeaway from Smart Stock Sam today. Near the 200-day moving average, with a short squeeze setup building, a $3.5 billion cash cushion, reaffirmed guidance, and a mid-June launch catalyst on the horizon, ASTS offers a compelling risk-to-reward opportunity for investors who have done their homework and understand the volatility they are signing up for. This is not a stock for the faint of heart. It never was. But for those who believe in the cell tower in the sky thesis, the current setup may be the entry point you have been waiting for. Now I want to hear from you. Drop your answer in the comments below. Do you think AST SpaceMobile executes a clean double satellite launch in June with no anomalies, or does the streak of bad luck continue? That is the question that determines everything from here. If this breakdown gave you value today, please hit that like button. It helps this channel more than you know, and it tells the algorithm that real investors are here for real analysis. Subscribe to Smart Stock Sam if you haven't already, and if you really want to support independent research that cuts through the Wall Street noise, please consider sending a super thanks using YouTube's support feature. Every contribution goes directly back into making this content better for you. I'll see you in the next one. Stay sharp, manage your risk, and as always, smart investing starts here.